Those clean, branded buses that promised to rescue us from Matatu chaos? That was SWVL, the app that swept into Nairobi like a brand new sneaker, offering cheaper, smoother commutes. But almost overnight, it froze operations, fired staff, and eventually vanished. Today, we're walking through the entire journey, the big ambition, the Kenyan expansion, the internal battles, and what ultimately caused the collapse. SWVL's story didn't start in Nairobi. It began in Cairo in 2017, founded by Mustafa Kandil, Mahmoud Noor, and Ahmad Sabah. The concept was simple and appealing. Use technology to coordinate private buses and fix shuttle routes so riders could reserve seats on clean vehicles instead of gambling with unpredictable matatus. That was the promise. Cheaper than taxis, cleaner than public matatus, and far more dependable than waiting around for a boda or random bus. And the idea exploded quickly. They raised massive funding rounds, and by 2019, they were expanding internationally like a startup on caffeine and investor hype. Let's simplify two terms you'll hear often: SPAC and IPO. A SPAC is basically an empty shell company created to acquire a startup, letting that startup join the stock market faster. It's quick, messy, and comes with sky-high expectations. Investors want rapid growth, or they get frustrated. SWVL entered Nairobi in early 2019 with a handful of routes, claiming it would reform city commuting. They introduced tidy buses, fixed timetables, and even free Wi-Fi on some rides, at one point partnering with BRK. They reportedly injected serious capital in Kenya. Media mentions at the time spoke of multi-million shilling investments to expand routes and marketing. Nairobi was appealing because the traffic problem is real and commuters will pay for consistency. And here's what SWVL offered locally. 1. SWVL Daily, scheduled city routes for everyday office commutes. 2. SWVL Travel, longer distance trips like Nairobi to Nakuru. 3. SWVL Business, corporate transport for companies. 4. Other experimental categories, additional features they tested along the way. Everything was sleek and easy. Book on the app, pay, show up at a set time, and ride. No chaos, just a straightforward experience. At first, users genuinely enjoyed it. Office workers especially loved the predictability. SWVL had strong tech, a polished brand, and plenty of venture capital to advertise aggressively. They expanded fast, even testing long-distance deals with wild discounts to attract customers. And yes, everyone remembers those free rides. But Kenya's transport sector isn't an empty sandbox. It's a living system made up of matatus, conductors, regulators, SACCOs, and unions, each with its own interests. SWVL's modern approach looked perfect in theory, but on the ground, resistance appeared. To understand why, you have to know that matatus aren't just transportation, they're livelihoods, culture, and revenue. If SWVL captured passengers, that meant less income for mat operators, so they watched and sometimes pushed back. Then came regulatory hurdles. In 2019, SWVL faced suspension orders. NTSA questioned how these new tech-driven buses fit within existing rules. Some routes were stopped, approvals renegotiated, and operations resumed only after back-and-forth discussions. It was an early lesson. Fast-moving startups collide hard with government bureaucracy. You can't scale a bus fleet without regulatory alignment. Fueled by venture money, SWVL kept pushing hard. In 2021, they announced a merger with a SPAC called Queen's Gambit, which would list them on Nasdaq at a valuation reported around 1.5 billion shillings in headlines. The deal was expected to unlock hundreds of millions for more aggressive expansion. But public listings bring pressure. New investors demand rapid growth. That's exciting until you burn money faster than you earn it. Let's break down unit economics. It simply means asking, for each passenger we transport, do we make money or lose money? If the cost per ride, driver pay, buses leased, fuel, maintenance, plus tech and staff, is higher than the fare, then growing simply means losing more money faster. After the public listing, everything began to unravel. In May 2022, SWVL announced huge layoffs, cutting about 32% of the global workforce. A few months later, in June 2022, they halted the daily and travel services in Nairobi. The official explanation was global economic pressure and rising costs. Their spending had been heavy: marketing, leasing fleets, running operations, hiring staff. When global markets tightened, the weaknesses became visible. Additional layoffs followed that same year. Planned acquisitions fell through, the company pulled back from several countries, the stock price tumbled, investor confidence faded. Their once massive valuation evaporated. Many startups face the same reality. Scaling without profit is fragile. Here is why their model struggled. SWVL relied on renting buses, paying drivers, fueling vehicles, cleaning, repairing, and maintaining a tech team. When fares dropped or ridership declined, especially with COVID and remote work, those fixed costs kept draining money. Asset-heavy business models collapse quickly when revenue slows. In Kenya, SWVL paused consumer-facing services in June 2022, meaning daily and travel shut down. Corporate transport lingered a bit longer. Reports indicated that public passenger services ended while the B2B side tried to continue. Later documents and regulatory filings showed SWVL restructuring globally and reconsidering its consumer model across multiple countries. By late 2024, their website removed daily and travel, focusing instead on enterprise and government mobility tools. The pivot was obvious, from running public commuter buses to selling mobility software and fleet management solutions to businesses and cities. The CEO publicly denied full shutdowns, but the product offerings told a different story. Then came more headlines, bankruptcy claims, and ongoing financial trouble. Reports from 2024 still showed large losses, proving the recovery was rough. Let's simplify B2B versus B2C. So B2C, selling rides to regular passengers like you and me. B2B or B2G, selling software or transport management to companies or government. B2B doesn't look glamorous, but the contracts are steadier and marketing costs are lower. If you land big clients, margins can be healthier. SWVL didn't entirely disappear. It demonstrated that tech could bring order to scheduled transport. And it sparked discussions about corporate mobility, routing analytics, and fleet digitization. Many companies in Kenya realized routes could be optimized, payments automated, and staff transport simplified. Even though SWVL paused public services, its influence planted new ideas in the mobility sector. And that's the full story of SWVL's rise, fall, and transformation.